So you guys know the fundamental differences between financial and tax reporting. The financial statements are for external users. The tax return is really just for the IRS. So the financial statements, we use pre-tax financial income and calculate a book tax expense. But for taxes, we create a taxable income and then come up with income taxes payable. And these very rarely agree. The only time income tax expense and income tax payable agree are if we have absolutely no book tax differences, which just depreciation ruins that. And so these will almost always be different. So net income per books is based on GAAP, tax expense for the current period times a rate. Now this includes federal, state, and international taxes. So on the financial statements, you'll have a lot more detail than what we do in our homework. We focus just on federal, and then you add the complexity of state and international. If you're curious about state and local taxes, a few of you have emailed me about that. We have one chapter about it in the book. We don't have time to cover it in the class, but I did do some work with state and local. So if you wanted to talk about what that's like, I'm more than happy to from a career perspective. Taxable income is determined based on tax laws, not GAAP, and we saw that in chapter 5. So you've seen the reconciliations we have to do. And the items that we have to reconcile are either permanent differences or temporary differences. So that all is kind of a review from chapter 5. So the journal entry when we're recording tax expenses is, you debit tax expense and deferred tax assets because we would debit expenses and assets, and we credit deferred tax liabilities and taxes payable. Now, the important thing is that tax expense is not a calculated item from this perspective. So we calculate DTAs and DTLs just like we did last week with chapter 5. We figure out what are the temporary differences, apply the tax rate, and then calculate and update our DTAs and DTLs. Taxes, excuse me, taxes payable, we do with the tax return. We figure out what do we actually need to pay. And then tax expenses is a plug. We can't actually just apply a percentage to come up with book tax expense. And that goes on the income statement. And so you have a balance sheet approach here where you're first considering the assets and the liabilities that are associated with tax expense. And then you figure out what's actually payable. There's a liability on your balance sheet. So you have to consider the asset and both liabilities, and then you plug the expense. Now, until you learned about this the first time, you probably always saw book tax expense as whatever book income was times some percentage, and that's what we use like an intermediate one. But it's a little more complicated than that when we introduce deferreds. So there are two sources of permanent differences. Some items are recorded in the books, but never on the tax return, which we just talked about. Others are never recorded in the books, but are recorded on the tax return. It's kind of a simplistic picture, but it really simplifies it so that you can think about each item you're considering. And if either of these two describe the item, then you know it's actually a permanent difference. It's not something that's going to wash out with timing. It's actually something that will always be treated differently. There are no DTAs and DTLs when you have a permanent effect. It's not deferred. It's not something you're going to recognize later. It's just a difference in the year that it happens. So temporary differences, if it's a revenue or a gain, if it's recorded in the books earlier, it's a liability. If it's recorded in the books later, it's an asset. You guys already think through these pretty well, but this is a nice little cheat sheet if you wanted to keep the slide with you to remember how to treat these items. It's not actually a cheat sheet because I told you could use it, so we'll call it a help sheet. The tax provision. So ASC 740 takes a balance sheet approach. And like we just talked about, you're going to compute taxes due on the tax return, but it's almost always an estimate because you don't know, you're gonna have to true up when things are actually finalized. And so you're tracking all this on the balance sheet and then you true up when things become certain. So it's a lot of estimations and a lot of subjectivity until you get to the point where you have something certain. DTAs and DTLs are adjusted from prior year balances to current year balances. That's one of the most common things that students miss is they see a company, it's in its second year of operations. So what are the DTAs and DTLs? Tell me the entry. And you forget that you started with some balances in those assets and liabilities. So you're making adjustments to those accounts. You're not creating new ones. Tax expense is always a plug. The deferred portion reflects changes in expense based on changes to DTLs and DTLs as you update those accounts. The current portion is just that balance left of tax expense. If there aren't any transactions related to prior periods, the current portion of tax expense will equal taxes payable. But that's really fairly rare. So let's do some examples. I think that usually makes it a little easier than just listening to me talk about it. So Howard Corporation began operations in 2019. Pre-tax financial net income was $400,000 and their tax rate is 20%. Financial net income properly reflects the following items. So we want taxable income, taxes payable, DTAs, and tax expense. So you have these 4 items. We know warranty expenses, gross profit on construction contracts, depreciation using straight line, and then we have a meals deduction on the books. And so we want to go through each of these items and think about what is the difference. Is it a DTA or a DTL? What does it do to our entry? And then what is our effective tax rate? So book income is $400,000. You guys just have a blank slide so you can take notes on which part you want to. So we have that warranty expense, and it said that warranty expenses is $20,000. That's accrued warranty expenses, but we haven't actually done any work. So for tax purposes, we can't recognize those. We can't deduct those expenses because we haven't done the work associated with them. So we'd have a $20,000 warranty expense. $20,000 warranty expense, and then we'll have to figure out, is that an increase or a decrease? Is it a DTA or a DTL? Gross profit on construction contracts using percentage of completion for books was $150,000. But using the completed contract method, which we have to use for tax, is only $50,000. So there's a $100,000 difference there. Depreciation, books was 30, makers was 75. So we have a difference there. And then we have a difference of 10,000. So the first part when you see a problem like this is to just list out what are the differences I know about and just get them written down. And then you'll think through, okay, would this create a DTA or a DTL? So the $20,000 in warranty expense, this was deducted for book purposes, but it has to be added back for tax purposes. So would that be a DTA or a DTL? Because we're going to deduct it on the tax return later. So it's going to reduce tax expense later. It's really confusing on what's an asset and what's a liability because you're thinking, well, I can't deduct it, so it must be a liability. So this year you can't deduct it, so it increases taxes. But in the year you can deduct it, it decreases taxes, so it's an asset. So you're always thinking about what's the effect when we reverse this rather than what's the effect on taxable income this year. Construction revenue. We had $150,000 for GAAP and $50,000 for tax. So we've recognized revenue on the income statement that we cannot include, or that we do not include for tax. So that's going to be a deferred tax liability because we have $100,000 in revenue for taxes that we'll recognize later. So we'll report that income to the IRS later, which means we're going to have a liability associated with that income later. Makers was larger than book, which means that we deducted more for tax purposes. So when this reverses, he's yelling at the dog, sorry. When this reverses, we will deduct less for tax, more for book. So that's going to be a deferred tax liability as well, because the deduction in future years will be smaller for tax purposes. The meals expense, does that create a DTA or a DTL? That's right, it's a permanent difference. So we're not going to worry about if it's a DTA or a DTL because it's never going to be included on the tax return. That's 50% of meals, it's always excluded. So now we've figured out that we have our book income, we're adding back expenses we couldn't recognize, subtracting revenue that we didn't recognize yet, work our way through the list, and we have our taxable income. The tax provision entry has 4 accounts: DTA, tax expense, taxes payable, and DTL. So we now know what taxes payable is. Next, we needed to figure out the DTA and DTL. So then we can plug our tax expense number. To do that, we'd use T accounts. We're going to go back to the very basics. So for the deferred tax asset, we have one thing that created a DTA, and that was warranty expense. So there was $20,000 in warranty expense that we could not deduct for tax purposes. Why is the DTA only $4,000? Yes, so the tax rate is 20%. So the deferred tax asset is actually for the amount of the tax expense that you'll have later, not for the full amount of the deduction. And so our deferred tax asset increases by $4,000 because of this warranty expense temporary item. Then for deferred tax liabilities, we have the same process. So construction revenue, it's $100,000, 20% of that is $20,000. And then depreciation, it was $45,000, so 20% of it is $9,000. So you add those together and you now have a deferred tax liability of $29,000. So now we have the 3 balance sheet pieces of the entry we can plug to get the income statement item. So the DTA is $4,000, taxes payable is $56,000, the DTL is $29,000. So when we make that entry balance and plug tax expense, we get $81,000. Now, sometimes students get confused about, do I do taxes payable first or tax expense? Which one's the plug? There are 2 ways to think about it. One is I do my balance sheet accounts first. So payables would be with the DTA and DTL. The other is you pay the IRS first, right? And so always think about payables first. Next, we can calculate the effective tax rate. So we know that our book income was $400,000 and our book tax expense is $81,000. To figure out the effective tax rate, we would divide $81,000 by $400,000. We get 20.3%. And you can see the note here. Why is it higher than 20%? Because there was a non-deductible expense. So this one only had one non-deductible expense. And so it was really easy to see where that 0.3% came from. In the notes to the financial statements, you have to reconcile from the book rate and then, or from the statutory rate, and then each thing that deviated from that to arrive at a reconciled effective tax rate. Example 1, part 2. So now let's do a very similar process, but we're going to work on it for the second year that this company is in operation. So it works very similarly to what we just did, except now you have a roll forward DTA, DTL balance and slightly different numbers. Okay, everybody's back. So here's the solution. You guys, as I walk through the groups, I think everyone was mostly on track, which is good. This is just the second one we've done. So then we're going to add net warranty expense because we reversed some of the prior one, but then we added more accrual. Add the construction revenue. Now this is the opposite effect of last time's because now the 2 methods have started to reverse. Makers is still more than book. We still have to add back that half of meals expense. And we had tax exempt income that we have to subtract. So the net warranty expense is going to increase the DTA. Now notice, instead of creating a DTA or DTL, these are increasing or decreasing them because these are assets and liabilities. They're permanent accounts. So as we adjust them, we'll increase or decrease where they are. So if we increase the DTA by 2,000, and then construction revenue is actually decreasing the DTL. Now it's really easy to assume we need to create a new DTA, but if we kept the DTL like we had it in the first year and then made a new DTA as it reversed, those 2 accounts would never go away. They'd never reverse each other. They would just sit in the 2 balances, even though the net effect was 0 after time had passed and it had all reversed. So once the DTL exists, you're going to decrease it as it reverses instead of create a corresponding DTA. The depreciation one is the same, it's just additional DTL, and then these other two are permanent. So taxable income was $463,000. Tax rate's 20%, so taxes payable is $92,600. So we have one of our three balance sheet accounts for the entry. Next, we need to think about what does this do to our T accounts. Now, remember, these are permanent accounts, so the first thing you would do with your T accounts is get those prior balances and make sure they stay in your T account. So we had an existing DTA of 4,000. We're adding another 400 because we increased it. So now our new balance on the balance sheet is 4,400. Our entry will only be the new amount we've added. DTLs, we had a 2019 balance. We decreased the DTL, increased another one. So we have a new balance of 38,000, but the net entry to deferred tax liability was these two together, so 9,000. So our entry is the 400 from the DTAs, the 9,000 from the changes in DTLs, the 92,600 for taxes payable, and then a plug for tax expense. So now we've seen the first 2 years of a company's operations. We've thought about different types of permanent and temporary differences, and we have created and adjusted DTAs and DTLs, and we've done the journal entry twice.